Hello, everybody. Greetings to everybody online who has been so patient. I'm Steve Clemens. I direct the American Strategy Program here at the New America Foundation, and I've just gone around the world via Doha, then to Tokyo, then Okinawa, and then Chestertown, Maryland, in which I was racing back from, so my apologies for being a few minutes behind. I'm very excited about today's program. We have two outstanding chroniclers of our times who've thought deeply both about the political contours and the economic contours of the choices facing the country and how our leadership at the moment is dealing with these challenges. My very good friend Bob Kuttner, who I think had a great deal of hope in the Obama administration and where it was going, has had some of those hopes punctured, I think, and he has chronicled this in his new book, A Presidency in Peril, which is in fact designed to be a shot across the bow, a wake-up call, all of the above. The inside story of Obama's promise, Wall Street's power, and the struggle to control our economic future. I have the book. I recommend to everyone watching online, go on that Amazon link and get it. And then my friend Simon Johnson, author of 13 Bankers, The Wall Street Takeover, and the Next Financial Meltdown. Of course, we know Simon, who is an outstanding blogger with Baseline Scenario, former chief economist of International Monetary Fund. Bob, of course, is the co-founder and co-editor of the American Prospect magazine, both very distinguished commentators. But I was with both of them recently in the halls where John Maynard Keynes used to walk around at a conference organized by the Institute for New Economic Thinking, which had received a lot of financial support from George Soros. And while there, Dominique Strauss-Kahn was speaking, and some protesters came along and brought a flag. I was sitting there with my iPhone and snapped a picture, which I quickly uploaded to my blog, and was noting that various distinguished personalities, Joe Stiglitz, Ken Rogoff, others were in the audience, Bob Kuttner, and I also listed Simon Johnson, but in fact I was wrong. Simon wasn't there. He was in the back room with those that were being tossed about by the security guys. In fact, Simon had this nice little red backpack, as I recall, and he was actually detained by the porters at the college, thinking that he might be one of the protesters. Which is amusing on so many different levels.
The story gets better every time you tell the story, Steve. It gets better.
It is great. So without further ado, let me invite in this very unusual but important two-book program, Simon Johnson to join us first, and then Bob Kuttner to come up, and then we'll enjoy a discussion. So please welcome Simon Johnson.
Okay, thank you very much, everyone. Thanks for this opportunity, and it's a great pleasure to be here with Bob and Steve. So my book is specifically about the financial system, and specifically about what happened in the aftermath of the crisis of September 2008. And I would put the message very, very simply as follows. We built a dangerous financial structure. We created banks that turns out are too big to fail. When they get into trouble, they need to be rescued in an unsavory, unpleasant, and manner that creates future problems. That was the experience of September 2008. And then we didn't fix it. It's not changed. In fact, if anything, it's gotten worse, because while you can argue, I think, reasonably about the extent to which certain key players prior to September 2008 thought they were too big to fail, now it's clear, now it's obvious to everyone in the financial sector, in the credit markets, that banks as big as, for example, Goldman Sachs can't fail. The largest financial institution that was allowed to fail last year was CIT Group, which had a balance sheet of around $80 billion, 80. And they were a specialized lender to small and medium-sized business. They demanded a bailout. They said to the government, if we don't get a bailout, there'll be awful consequences for small and medium-sized business. And the government, this administration, to its credit, turned them down, and they failed. They defaulted on their debts. And no one can show you, and I talked to a lot of people on the academic side and on the practical side, people in these markets. No one can show you any disruptive effect of the failure of CIT Group. That was a success from a capitalist system point of view, right? They failed. We went on. Goldman Sachs has a balance sheet that fluctuates around $800 billion, 800, 10 times bigger than CIT Group. Does anyone, let me ask you this, does anyone in the room today think that if Goldman Sachs were to hit a rock, a hypothetical rock, for example, this week or next, that they would be allowed to fail, that their government would step back and they would just be allowed to collapse? Does anybody think that Goldman Sachs can fail? The last time I asked this question, actually, it was in New York, and 2 people raised their hands, but it turned out they had a big short position in Goldman Sachs, so that's just New York for you. Does anybody think, after the legislation passes, after this bill, which almost certainly is going to be reconciled between House and Senate versions and most likely signed by the President before July 4th, does anybody think that this financial reform bill, the 1,400 or so pages, does anyone think that that bill will make it possible for Goldman Sachs to fail? I don't think so. I work on this every day. The website we have, Baseline Scenario, is very much about tracking the process and writing about it. And we've been involved in trying to help some truly superb representatives of the American people in the Senate. We've been trying to help them push for sensible reform. And there was, I must say, a vote on the Senate floor on the so-called Brown-Kaufman Amendment. Senator Sherrod Brown of Ohio, Senator Ted Kaufman of Delaware, put forward a very reasonable, moderate proposal that would have capped the size of the largest 6 banks. Only 6 banks, by the way, would have been made smaller, and it would also have limited the degree of leverage, how much they could borrow. And these are ideas that are very consistent with what we proposed and put forward in our book, 13 Bankers. So the good news is Brown-Kaufman got a vote. The bad news is it was defeated, 33 to 61, 30 Democrats, 3 Republicans. So that was it. That was the big opportunity. And the administration has said very clearly, plainly, and for the record, that Brown-Kaufman failed because the administration, were opposed. The Treasury says this. They said if we had supported Brown-Kaufman, it would have succeeded, but we didn't support it, so it failed. So this is an extraordinary moment, I think, in the history of the American economy and American society, because there's agreement at the level of people who study these questions carefully. There's agreement on the left from someone like, say, Joe Stiglitz, and agreement on the right from someone like Gene Farmer, University of Chicago, the widely recognized father of so-called efficient markets view of finance. Stiglitz and Farmer agree that too big to fail, the system we have now, where the biggest banks can't fail, is not a market. It's nothing to do with a market. It's a hidden, unfair, and dangerous taxpayer subsidy. And I say, I often get a question from one of my Republican friends. I still have some Republican friends, even after writing the book. I have a lot of them, actually. And somebody who's usually a Republican in the audience raises their hand at some point and says, Simon, what about Fannie Mae and Freddie Mac? What about the perception prior to September 2008 that they were too big to fail? What about the distortion in incentives and activities that arose in that case? And I always respond the same way, 3 words. You were right. Fannie Mae and Freddie Mac were a problem. They became too big to fail. They didn't have enough capital. They took on too much risk. They captured their regulators. They spent an enormous amount of money and effort lobbying the legislators. I don't think they were central to what happened in September 2008. I think the central part was the private banks, the big banks, the JP Morgan Chase, Citigroup, Goldman Sachs, Morgan Stanley, Bank of America, and Wells Fargo. Those are the ones left standing. But there's no question Fannie and Freddie had a big problem. But take away those names, hide the names now. Just think about the structure of the incentives and power in that analysis from the right. That's what we have today. I mean, JP Morgan Chase, I understand JP Morgan Chase, Jamie Dimon, claimed to be a private enterprise. Mr. Dimon said to his shareholders recently, if we're big, it's because we're good. If we get bigger, that's the outcome of a normal market process. It's not. This is a subsidy scheme. JP Morgan Chase has become a form of government-sponsored enterprise. I mean, I know that people don't talk about this. The Treasury would never use those words in public. But they're too big to fail, and the market knows this. Now, Freddie and Fannie had an implicit subsidy from the government estimated between 20 and 40 basis points, 0.2, 0.4 percentage points. They could borrow cheaper than other people because of the implicit government guarantee. Estimates of the implicit guarantee for Mr. Dimon and the other too big to fail bankers vary, but somewhere between 60 and 80 basis points at the moment seems like a fair assessment, which is a huge amount of money in this market. And of course they can get bigger. And by the way, there are no economies of scale or scope in banking over about $100 billion in total assets. Actually, you could draw that line lower. You could go down to 50 billion if you wanted, or even 30 billion. But let's be generous to the bankers and say 100 billion. Our banks, Goldman, as I mentioned, 800 billion. It was 1.1 trillion at the time of the crisis. Citigroup was 2.5 trillion at the time of the crisis, now slightly under 2. JP Morgan with Mr. Diamond are around 2, I think pushing on to $2.5 trillion. This is all private benefits. At that scale, it's all about the private benefits. There's no social benefits. Mr. Diamond likes to claim that global non-financial enterprises need a global bank like his in order to operate effectively around the world. It's not true. You can talk to the CEOs of non-financial companies, which is what I do. You can ask them this question. You can talk to the CFOs, the chief financial officers. You can ask them this question, which is what I do and my colleagues do. They don't need trillion-dollar banks. They need good banks. They need banks that don't blow themselves up. They need banks that understand their customers. They need banks that are not abusive. But they don't need trillion-dollar global banks. Not at all. So what it comes down to now is the power of some very big banks. Now, there are broader issues. There's a lot of deeper problems, and I'm sure Bob will talk about them. But my focus is very specific and perhaps even rather narrow right now. Gene Farmer says too big to fail perverts, his word, perverts activities and incentives. And he's right. Joe Stiglitz says that this concentration of financial and economic and political power is fundamentally dangerous. And he's right. And Paul Volcker, not known to be a radical of either right or left, made some very modest, sensible proposals about how to deal with this, part of which were taken up by the administration. Mostly they were diluted through a lackluster support by the Treasury and the White House, and most of which I think will end up completely on the chopping board and on the floor in the reconciliation process. Because the banks are too powerful. And it's interesting. Why are they powerful? And I'll end on this point. What is the basis of this power today? I think if you look at the past, if you look at what we wrote about in the book, the rise of Wall Street, there are three main mechanisms of power. Actually, the nicest review, we've had some very nice reviews, including from Steve, on the book. The nicest review was one in Business Week, where a journalist said he liked the beginning of the book and the end of the book, but the middle of the book was just so totally obvious now about Wall Street taking over Washington, running everything. Everybody knew that. It was boring. Well, I have to say, if that's true, if everyone does agree, then that's a great success, and I'm very happy. I don't think it's quite that uncontroversial. But let me review for you the three main mechanisms. The first was ideology, convincing people in power that finance is good, unfettered finance is better, and completely unregulated large banks are the best. That idea, I think, has taken a bit of a pounding, and hence my appeals to the right and to the left, top thinkers on this issue. I don't say the ideology is dead. You do see it still make some appearances, but I think we are winning that battle. The second tool, the second mechanism for this power, was obviously the revolving door between Wall Street and Washington. And again, I think some progress has been made. The administration, to my direct specific knowledge, still hires people from Goldman Sachs. They just don't talk about it quite as much. So that's good. People are embarrassed. They should be embarrassed. And again, I think the consensus starts to shift on that. The third mechanism, though, of course, is the decisive one right now, and it is a huge problem, and that's the money. So the reason, in my assessment, Bob can tell me if I'm right or wrong on this, we can discuss, that my assessment is the administration did not support Brown-Kaufman specifically, or reform more broadly, because they're afraid of the campaign contributions, first of all, that they would lose and not get for November this year and for 2012, but also for the effect they felt they would have if the money was all thrown onto the other side of the aisle. It's the money. It's money, pure and simple. And I think that's what we need to focus on going forward. The visibility of that money, explain to people how the money works, really unpackaging the precise mechanisms through which the special interest exerts this degree of power. And I'll be quite frank with you. My goal here is not to persuade you today. I don't think that's how this kind of process works. It's to get these issues out there, to get you arguing about them, to get you pushing back, to have you take this forward, take it up with your colleagues. What I want to do is change the consensus. In 1902, when Teddy Roosevelt decided to take on the large industrial and railroad trusts, initially with bringing a case against Northern Securities, this was a big shock to the mainstream public. To people like you in 1902 would have absolutely not understood what Roosevelt was about. Well, first of all, the Senate was called the Millionaires Club for a reason. It seemed like a impregnable bastion of industrial privilege. And so nobody thought Roosevelt could win under those political circumstances. And secondly, very few people understood why this was a good idea. The notion that monopoly, that big business could form a monopoly and that monopoly could be bad for society was not a mainstream idea before Roosevelt took it up. There were some people who'd written about it, to be sure, and there was a broader progressive milieu, the ideas of which Roosevelt appropriated. But there was no widespread agreement that monopoly was a huge problem that had to be overcome. J.P. Morgan came to see Roosevelt, by the way, in February 1902 at the White House. And he said, if we've done anything wrong, send your man to see my man and we'll fix it up. And Roosevelt and his Attorney General, thank goodness, said, no, we don't want to fix it up. We want to stop it. And they took the case to the Supreme Court and they won 5-4. And out of that came the legal tools for antitrust. But out of that discussion and that social debate came a big shift in the consensus. And 10 years later, when Standard Oil was broken up, it wasn't particularly controversial. And it was broken up in classic American style. 35, 37 separate companies formed. The shareholders in most of these companies did very well. The Rockefeller family rehabilitated itself with acts of wonderful generosity and created a much better basis for economic progress in the 20th century. Who here, by the way, would like to reinstate one oil company with a 90% market share of all petroleum products in the United States, even if it wasn't BP? Who would be in favor of that? 90%. Any takers? Again, last time I asked this question, somebody raised his hand. It turned out he worked in the oil industry. You all understand it is completely ingrained in your thinking that monopoly can be bad. Right? In an industrial sense, for transportation services, you would look at this and look at a politician who was proposing this with grave concern. It's the same thing with banks. We have to change the thinking. We have to understand, we have to move the mainstream. We have to understand that Farmer is right, Stiglitz is right, Volcker is right. Too big to fail is too big to exist. And when the consensus shifts on that, the politics will shift. Thank you very much.
Simon, thanks so much, and thanks, I think, as well. You know, I would tell people who are watching online, and those of you who are in the room, that one of the great resources I think that New America Foundation has online is a program we did in December 2007. It was our first Bernard Schwartz National Economic Symposium. Simon spoke in that, Desmond Lockman of AEI and others, David Hale. And if you go back and look at what these gentlemen shared, it was incredibly prescient given what we saw unfold. So the notion that there weren't important people sort of seeing what was going to happen with bubbles, with financial regulation, with the too big to fail issue are wrong, and this is online. Bob Kuttner, I owe Bob a bit of leveling out here. Bob wrote a very influential, at least for me, article in the Huffington Post called Team of Rubens. And I was quoted in a very interesting piece on Rolling Stone on Barack Obama's economic team. And I said, like Bob Kuttner said, Barack Obama hired a team of Rubens, not a team of rivals. And this got assigned to me, and I've been benefiting ever since greatly. But I want to thank Bob Kuttner for inspiring the thought and give credit where credit's due. But Bob Kuttner.
Well, I thank you. thank you all for coming. I guess I'd rather be remembered as the person who got these people fired than as the person who came up with a quote. Speaking of quotes, I want to start out with three. Um, the British historian of the 19th century, A.J.P. Taylor, wrote about the Revolutionary Year 1848. And this was a year when liberal nationalist revolutions broke out in Central Europe on the part of people who found themselves in somebody else's empire, who wanted a modern liberal nation state. And within 6 months, all of them were crushed. And Taylor wrote that it was a turning point of history on which history failed to turn. We will soon find out whether that is the epitaph for what should be a great era of reform comparable to the New Deal. And that's really what my book is about. A lot of it is about the financial and economic challenges, paralleling Simon's work. I don't think there's any fundamental thing we disagree on. But a lot of it's about the politics, the odd question of why Barack Obama, an outsider, a teacher, a progressive, a leader who inspired people, 71% of first-time voters voted for Barack Obama in November of 2008, why he has not to date seized what should be and could be a Roosevelt moment. Second quote, a little bit of evidence. I found this just an extraordinary quote. Increasingly, I found myself spending time with people of means, law firm partners and investment bankers, hedge fund managers, venture capitalists. I know that as a consequence of my fundraising, I became more like the wealthy donors I met, in the particular sense that I spent more and more of my time above the fray, outside of the world of immediate hunger, disappointment, fear, irrationality, and frequent hardship of the other 99% of the population, that is, the people I'd entered public life to serve. That is Barack Obama, buried about 200 pages into his book, The Audacity of Hope. So I certainly share Simon's view that it's part ideology and part money. The third quote is from the now retired governor of the Bank of India, Dr. Yaga Reddy, who I found myself on a panel with at the United Nations in the fall of 2008. And I said to him, India seems to have dodged this bullet. How did he do it? He said, well, yes, we are projecting 8% growth next year. He said, well, you know, we're a poor developing country. We don't really understand these complex financial instruments, so we leave them to the advanced countries like you. And the Indian banking system, by Goldman Sachs standards, is rather rudimentary. Banks take in deposits, they make loans, and Reddy, and he got tremendous pushback on this because, like bankers everywhere, Indian bankers wanted to be hedge funds, just like American bankers succeeded in behaving. But he used capital requirements to make it unprofitable for Indian banks to play these kinds of games. And now, of course, he is revered, but at the time he was vilified. And there was pressure upon him from the likes of Bob Rubin, maybe even from the IMF, to be more market-like, as if this stuff were market-like in any virtuous sense. So Steve was kind enough to mention my previous book, Obama's Challenge, and I wrote this book rather quickly in the spring and summer of 2008, and found a publisher who was willing to gamble, as I was, that we would either have a bestseller or a bonfire. And we got the book out in August of 2008, predicting that the crisis would be so severe that Obama would be elected, and then he would face a huge challenge. And the question was, would he rise to the occasion? And my gamble was that even though I had no illusions about whether he was a radical, as Roosevelt, by the way, was not in November of 1932, as Lyndon Johnson was not when he succeeded John Kennedy, that because of his intelligence, because of his odyssey, and because of the circumstances, it was an even bet that he would rise to the occasion. And I was wrong, at least so far. Now, one thing we know about Barack Obama is that he hates to lose, and he has a habit of coming from behind. But he's got an awful lot of ground to make up. And so I really didn't want to write a sequel. Sequels always bomb. This may have to turn out to be a trilogy if he somehow snatches victory out of the jaws of defeat, which is my fervent hope. But my heart sank when I saw the economic team that he appointed, because that made it incredibly difficult for him to be as radical as Roosevelt. And the hegemony of Wall Street, in so many senses, requires a break at least as radical as the break that Roosevelt made with Hoover. But if you look at who Obama appointed and the policies they pursued, it's almost as if Roosevelt had appointed Hoover's team. We basically had Larry Summers representing continuity with the deregulation of the Clinton era. We had Tim Geithner, who was Bernanke's deputy in effect at the New York Fed, representing continuity with the Bush Paulson era. We had Orsag, a protege of Bob Rubin, a budget hawk, and I'll come back to that in a moment. And then, for good measure, he reappoints Bernanke. So this is anything but an economic radical at a time when the circumstances required a radical break. So the question I pose in the book is why? And I have a few answers. They're still tentative answers. It's only 16 or 17 months in. One reason is if you read his prior writings carefully and you follow his prior political activities carefully, he is, as his friend Cass Sunstein describes him, very much an incrementalist in his philosophy of how you make change. Secondly, in terms of his temperament and his own life history, he is a seeker of common ground, a seeker of consensus. And we saw this in the stimulus package. We saw it in the health bill. He would get pummeled by Republicans again and again and again. It was clear as a bell that their main desire was to just destroy him, and yet he would keep coming back trying to find common ground. And it was only after the Scott Brown defeat, and even 6 weeks into that, where he tried by going to the caucus retreat of the Republicans in Baltimore, and then he convened his own summit conference at Blair House, over and over again to look for consensus that just wasn't there. Now, there are admirers of Barack Obama who say that this was three-dimensional chess, that he was thinking several moves ahead of everybody else, and that this was all just a way of setting up Republicans so that he could then do a Democrats-only bill. They were winging it. They were winging it a day at a time. And even though they won the bill, the health bill, there was so much collateral damage incurred along the way that at best it's a political wash rather than a victory. The decision to take $500 billion out of Medicare rather than tax millionaires to pay for it, that scared off seniors. The decision to tax premiums of people who have decent health insurance, that really alienated the trade unionists. The decision to put off the effective date for 4 years so that they could play budgetary games using a 10-year budget horizon. The decision to cut a deal going in with the insurance companies and the drug companies so that the people who everybody hate became your allies and completely muddied the waters in terms of the political narrative. All of these were political blunders. And yes, winning was better than losing, but in the fall, when only a little bit of this will have taken effect, there will be some kids under age 26 who are still on their parents' policies. There will be a little bit of help for 2/3 of the population that is not insured. 85% of the population is insured, and their insurance is eroding and becoming more expensive, and there's not much help in the bill for them. So this is not, contrary to a lot of the commentary that you read, a victory comparable to Social Security or Medicare, both of which were victories, by the way, for social provision. This is a victory for subsidizing the insurance industry. So both in terms of the policy and the politics, it is not at anything like that scale of a progressive breakthrough, even though the president's admirers will claim it is. So going back to my storyline, why did he not seize what ought to be a Roosevelt moment? So we have his character, we have his ideological preferences, and I think we have tactical considerations if you look back to the months of April, May, and June of '08. So here's Barack Obama. He's been the underdog. It dawns on him that he's probably going to be the nominee. And this is the period when his pastor, Jeremiah Wright, has become radioactive. It's a period when people are accusing him of being a secret Muslim, of having friends who are terrorists, and of not having the experience to govern in a deepening economic crisis. So the advice is send for the aid team. Bring in the most reassuring people you can find, and those turn out to be, unfortunately, not Stiglitz and Krugman and Johnson, but Summers and Geithner and Orszag. And I think that was not just a tactical choice. That partly reflects Barack Obama's own worldview. So where are we now? Well, I think some of the choices that Obama made, and this is now in the winter and early spring of '09, and Geithner and Summers are the point people for this. And there was a huge argument within the administration, with outside kibitzers expressing very strong views about, do you prop up the existing business model of the banks and the existing banks? Do you prop up zombie banks in order to reassure markets and get through this phase of the crisis? Or do you use the crisis as an opportunity to restructure them instead of pretending that banks that are insolvent but everything but name actually are solvent? You do what the FDIC does in the case of smaller insolvent banks, and you bust them up, and you figure out how big the hole is. You do an honest accounting. You figure out how much of a hit the bondholders take, how much of a hit the taxpayers take, and then you get a sound bank back in operation that can go back to the business of financing business activity. By pursuing the course that they pursued, propping up weak banks, you end up with a psychology of having to rebuild bank profitability and bank balance sheets, and you end up with banks that are risk averse. This is the Japanese story. It's the opposite of the Swedish story. The Swedes did it right. And so the decision that they made to continue the Paulson strategy, in addition to having all of the flaws that Simon so eloquently describes, has the additional flaw of being a drag on the recovery, and has the political flaw of reinforcing the impression, which is all too correct, that the administration cares more about Wall Street than it cares about Main Street, down to the double standard between the way community banks are treated and the way Wall Street banks are treated. Community banks did not go in for this exotic stuff. And when examiners come in and look at community banks, it's business as usual. It's, wow, you have some underperforming loans. You better make your customers, or you better raise your standards, raise capital, pull in lines of credit, even against good customers. So you've got, on the one hand, the administration thinking that it's trying to promote a recovery, but on the other hand, it's making life harder for community banks, which makes life harder for small businesses. And then on top of that, you now have austerity fever sweeping the entire Western world. Pete Peterson's foundation spends $1 billion a year. You've got an alliance between deficit hawks in Congress, the Peterson Foundation, people inside the administration like Peter Orszag, the Rubenistas in general, and the president's own fiscal commission, all making the argument that even though we still have 10% unemployment, 17 if you measure it correctly, and the private sector hardly creating any net new jobs, the bigger problem is to reassure financial markets that we're going to get serious about deficit reduction. Now, I'm part of a project called Fiscal High Road. It seems to me there are two ways long-term to get the deficit and the debt-to-GDP ratio under control. You can tighten your belts at a time when European countries are tightening their belts, and you can get to budget balance at a lower level of economic output, or you can have more deficit spending and social investment and taxation of very rich people so that the deficit doesn't go completely crazy in the short run, And then you can work your way to budget balance at a higher level of economic output. Now, I don't know how any sensible person could choose the former path. I'm not saying you can grow your way out of this recession. You can partly grow your way out of recession. That's why I think we ought to be phasing in taxes on very wealthy people, maybe the top 1%. And I've got a paper that I did for the Scholars Strategy Network that outlines a plan that would do that. I mean, I would like to see us by the year maybe 2020 having outlays of maybe 26% of GDP and revenues of maybe 24%, so that we don't only have a short-term stimulus in the Keynesian sense, but rather have social outlays that this country has never had at an adequate scale, and rebuilding of infrastructure, investing in 21st century infrastructure systems, filling in the gaps in our social safety net, and having a proper welfare state. And if you do that and pay part of it in the short run with deficit spending, which I think makes sense, and over the long term raise taxes on the top 1%, you have a much better road to recovery. You have a much better road to fiscal balance. And Simon the other day made the astute point, or am I confusing you with somebody else? I've been on so many platforms. Were you quoting Brad DeLong the other day? No, you weren't. All right, let me credit Brad DeLong then. So Brad DeLong, who's not somebody I ordinarily quote very often, the other day had an item in his blog which is very important. Namely, the U.S. government right now can borrow for 30 years at about 3.5%. That's a hell of a good deal. And if we need to spend another $500 billion over the next 2 or 3 years, we ought to be borrowing long. And the argument that by 2017, 2018, 2019, when the debt to GDP ratio peaks, we're going to have this huge toll in the annual budget of interest payments on the debt, it's really not so bad if you're only paying 3.5% on your debt. It's actually a hell of a deal. And so there's a Keynesian part of the story, there's a structural part of the story. The problem is that the President of the United States is not embracing any of this. And Simon and I are not running for President of the United States. We're trying to change public opinion, but the administration keeps raining on our storyline. And I think if he doesn't do more to prevent the next financial collapse, if he doesn't identify himself with the need of ordinary people for some economic relief and jobs and restructuring of mortgages so that the foreclosure epidemic doesn't keep dragging down the rest of the economy and cause human hardship, there is going to be a blowout of another kind in the fall. The Republicans are going to pick up very large numbers of seats in the House and in the Senate, and then the moment really will have passed, because even with heroic presidential leadership of the sort that we haven't quite had, he won't be able to get the kind of legislation through Congress that we need. So time is running out, and writing a book like this or doing blog posts like the ones I do or giving talks like this one is a real balancing act, because most people want this president to succeed, certainly most progressives do, and he's likable. As he said about Hillary Clinton, he's likable enough. People wish him well. People know that his success and our success are intertwined. So the challenge is to practice a kind of tough love, to really push him to be the kind of president that we hope he can be. And I'll close with this point. In looking back upon prior presidents, I realized that not only did they make the decision to become more radical in office than they were on the campaign trail, which is a decision that Barack Obama has not made yet, but they also had social movements pushing on them. Lincoln had the abolitionists, Roosevelt had the industrial labor movement, LBJ, who spent most of his career brokering between the Dixiecrats and the progressive Northern Democrats, decided that he was going to be the one to redeem the promise of Lincoln. But in all of these periods, you had movements such as Dr. King's movement in the LBJ era. And Teddy Roosevelt's an interesting case. I mean, you did have some precursors. You had the Sherman Antitrust Act of 1890. You had the populists. You had the progressive movement. And Teddy Roosevelt, of course, was an accidental president. He was put on the ticket in haste. He became president only because McKinley was assassinated. He was the opposite of a McKinley Republican. And he rose to the occasion, too. And it helps if you have social movements encouraging a president to rise to the occasion. I don't know if Simon and I constitute a social movement, but there is an eerie absence of social movements today on the progressive side, and a creepy growth of social movements on the far right, some of which is real angry populism, some of which is faux populism funded by corporations and by Wall Street. So, you know, if this were an episode of West Wing, it would be a hell of a drama, but it's our life, and it's our future, and it's a question of whether this is going to be one of those moments when history fails to turn, or is it going to be a transformative moment where we get back a managed form of capitalism, we get away from the kind of reckless speculation that took down the economy, we get, I'll say this in partisan terms because I'm a liberal Democrat, we get a social compact of which the Democratic Party is a steward, and we get a generational realignment like the 30s, where the young people who were attracted by Obama's candidacy become lifelong supporters of progressive Democrats. I see that movement right on the verge of evaporating, and I hope Obama hates losing enough that he still seizes the moment. Thank you.
Thank you very much. I'd like to open the floor, and I also want to give people time to acquire these books and spend some time with Simon and with Bob personally. But let me just ask, you know, Bob, in your last comments, which sounded so bleak, and I share that bleakness, I'm sort of thinking for a minute of George Soros. Soros, who he thinks did quite a great deal to help this administration come in, also wants Barack Obama to succeed, also has been frustrated with economic policy, trying to sort of think things through. And one can have a strategy like you guys are deploying, which is to try to change public opinion and, you know, sort of like in a Dr. Seuss thing, you know, we're here, pay attention. On the other side, it is just to accept the fact that I think the trends are the fact that they're not preparing to take the expansive new round of stimulus, sort of thinking, you know, like Martin Wolf said the other day, begin to love and embrace the bigger deficit that's coming, et cetera, and allow shocks to drive the process. I just came back from Japan, and in Japan, both the LDP and the Democratic Party of Japan are not in agreement, but both are looking at the levels at which they want to raise their consumption tax. When you look at Europe, as, you know, I've been calling it, you know, what's going to be the global deflationary black hole. And when you begin to think about what's going to drive global growth, what's going to put Americans back, it's a very bleak picture. And someone says, well, Barack Obama's probably preparing, given the influence of the Peterson Foundation and others, and sort of the ideology of economics, that he's going to take a Jimmy Carter approach and tell Americans this is a time for austerity, tightening our belt, and in the long run we'll be better. But I guess my question to both of you is economic and political, is what happens to global growth in the scenario if everyone's tightening their belt, except maybe China? And secondly, what are the political ramifications of that strategy? Do you sit and wait as part of the "we told you so" crowd, and in that "we told you so" moment, try and institute something very different? I'd love to hear just a little bit on that before I open the floor.
Well, I think obviously austerity is bad politics and it's bad economics. People, apart from the people on Wall Street whose bonuses have continued without so much as a, you know, by your leave, but other people have been tightening their belts. They've pre-tightened their belts. They were tightening their belts before the collapse. They've been tightening their belts more after the collapse. So why in the world would you think you could sell austerity? And Orzag has made no secret of the fact that the formula that they want the commission to adopt, and this is just astonishing for insularity, you add a value-added tax and cuts in Social Security, and then to get business buy-in, you cut the corporate income tax. Now, can you imagine selling that to the kind of middle-class, lower-middle-class voter who has really been whacked by this crisis, who took a chance on Barack Obama? Can you imagine the Republican TV spots. The Democrats have a secret plan. They're going to raise your taxes. They're going to cut your Social Security. And that Republican TV spot, unlike most, would have the virtue of being accurate. So this is, obviously, if everybody tightens their belts, you get global austerity. It's what the IMF did in its worst years. We've had some reform, but, and Simon can speak to this better than I can, but now the IMF has rejoined the austerity parade. I mean, the price for bailing out Greece and Portugal is that all of Europe now has to tighten its belts. And yeah, China's growing, but China has this habit of not buying other people's products. You know, China's export-led, as is Germany. And of course, everybody can't have export-led growth. So it's a, if they go down this road, it's a bleak economic road, it's a bleak political road. And I am not one of those who says, well, you have to pick up the pieces afterwards. I'd like to prevent this catastrophe going in. I think it was the German communists who said, after Hitler, us, and that was not a good slogan.
Simon?
Well, I agree that there is an excessive tendency towards austerity around the world. I think that is very much the problem in Europe. And I think it's the Europeans' problem, by the way, and the Europeans' conception. I think some of the things the IMF is proposing are okay in that context, but the Germans have taken it upon themselves to push this austere language. And as Bob said, you know, the question is one of timing here. It's also a question of how bad it is to start with, and what the root causes are. You know, if you about a 40 percentage point increase in our government debt is due to the banks and what they did, and that problem hasn't been fixed. So I don't understand how anyone can be a fiscal hawk without dealing with too big to fail banks. It doesn't actually make any sense. Just the logic of the situation. And you know, as for what the budget should be going forward, you know, Bob's right to think of this as in a medium-term framework. So you look out, in our case, you look out 10 or 15 years and decide, take a view on what level of debt to GDP is sustainable in that context. And clearly, some degree of tax reform is going to be necessary. We have a very inefficient tax system that doesn't collect a lot of revenue and does it in a relatively distorting ways compared to best practice around the world. Again, how can anyone be a fiscal hawk unless they're willing to address that? And I think there also has to be a much more open dialogue than the administration seems to want to push with regarding to where these deficits came from. I mean, I have many concerns about what the Clinton administration did in its later years, particularly around the financial system. But you have to face the reality that the fiscal position they handed over in 2000 was not that bad and became much worse. Again, I like America. I became an American. I took the test to become an American. I'm not sure how many of you have taken the test, but I did very well on that test. And I like the democracy, and I like the kind of debate, and I like the arguments, and I'm welcome the fact that people want to come and have this argument about the fiscal issues. Bring it on, is what I say. But we're going to have, you know, a pretty tough discussion about the merits of their case, just like we're having it with regard to the bankers. And I think that's remarkably healthy, much healthier than in Europe, by the way, where it tends to be much more insular.
Has Tim Geithner called you lately, just out of interest?
I really couldn't comment on that, Steve.
Okay.
You know, these things are confidential.
Yeah. Okay, good. Let me open the floor. Let me go to the second row right here. Wait for the microphone.
Hi, I'm Abby Woodward. I'm unaffiliated, but I used to work in state government in Georgia, and so I worked with state-level legislators, and they were very affected by the census and by redistricting. And so I'm wondering, is that possibly one of the underlying reasons that Obama is so slow in getting to something radical? Is he waiting for redistricting?
I don't think so. No, I think it's deeper stuff.
Let me go in the very right back here in the on the aisle. Yes.
Thanks. Steve, I want to know why you're always coming back from Japan. But, Mr. Kuttner, I've heard you use the 3.5% over 30 years a couple times. Could you explain to me what that's about, what the basis is for that,
Thank
you know, in terms of,
Well, right,
Yeah.
okay.
so we can really understand. And also, if because I know where you're coming from, you and I we know we're coming from the same place. And I have both your books.
Quick question.
Could you
Let's get to your question.
give us some more slogan or messaging for how we get this out into the public.
Thank you.
Putting Americans back to work and preventing foreclosures will get a recovery going a lot faster than tightening everyone's belt. That's the talking point. And ordinary Americans have suffered enough. We don't need to tighten people's belts further. We need to get a recovery going like we did during the Roosevelt era in World War II. And the 3.5% is simply the fact that despite the fact that the United States economy is in no great shape, you have to ask the question that, Henny Youngman asks, how's my wife compared to what? How's the dollar compared to what? It turns out that there's a so-called flight to quality. And because the private market economy is dead in the water, and because other currencies are either administered, managed, or they're in worse shape, a lot of people still want to buy dollar securities, and they want to buy U.S. government bonds. So, if people are willing to lend Uncle Sam a lot of money for 30 years at about 3.5%, put it to work, putting Americans back to work.
Let me just go to the right over here. And ask just, we'll take both of you, but ask just one question each. There are too many questions to go to take multiples.
Okay. I'm a little surprised that neither of you mentioned the Glass-Steagall fight. By the way, I'm Ed Spanos. I write for Executive Intelligence Review, work with Lyndon LaRouche. I mean, this was the biggest behind-the-scenes fight. And I think the best illustration of the case you were arguing about Wall Street's influence operating through the Obama White House. The amendment sponsored by McCain and Cantwell would have passed the Senate had Dodd allowed it to come to a vote, and he did not. The second most feared item there was Blanche Lincoln's provisions on derivatives, which were watered down by Dodd. She and Cantwell had the amendment to restore it. That also was not allowed to come to a vote. And I don't think that it's accidental that the Soros networks put a huge amount, millions of dollars.
Ed, I'm going to ask you to come to the question.
Yeah, trying to defeat Blanche Lincoln just now. So the question is, really, what does this tell us? What happened on the McCain-Cantwell amendment to restore Glass-Steagall?
Thanks.
What does that show about the Obama White House?
Thank you. Glass-Steagall? Simon?
So I disagree that that's where the big efforts were put. I think Senators McCain and Cantwell, had some proposals on the table. They didn't push them anywhere near as hard as Senators Brown and Kaufman or Senators Merkley and Levin. That's an interesting question. Why? Perhaps the hand of the White House was involved in there, or perhaps not. I think the Volcker rule, which has been taken up by Senators Merkley and Levin and applied, I think, in a way that is not perfect, but would be sensible. That is actually the spirit of Glass-Steagall. It is trying to separate relatively risky parts of banking from relatively safe, vanilla, boring parts of banking. And I think that is very much the issue that the reconciliation process is going to take up. I think reconciliation team will kill that, personally, which would be further discouragement. And I think they'll kill it because the White House will let them kill it, which would be awful. But that is where we are.
But how did that happen politically? When the Volcker rule was released, and it was a direct result of the results in Massachusetts, and Barack Obama allegedly being angry that he was in this position and said, let's unleash this. And when it was unleashed, then the other parts of the administration began to immediately push back, particularly Treasury and Larry Summers. And so here was our temporary monarch saying, I want this, but then his other wings coming back. I'd love to hear about this just a little bit more, because at the time, some of us are pretty well acquainted with Austin Goolsbee, and Austin was in the press all of a sudden a lot. He'd been squelched before that. We asked him, "Are you back? And are you really back?" And Austin's comment was, "Yes, I think so." But this died in a nanosecond. And do you care to comment, Bob?
Yeah, there's a lot of material on that in my book. Basically, Volcker was one of the earliest senior serious people to back Barack Obama. I mean, at the age of 80, he even went on the campaign trail with Obama. And then, although he was put on stage with the other advisors when they named the team, he soon realized that he was being used, and he was very angry about it. I mean, he said to a friend of mine, "My views of Tim Geithner are unprintable." And so, they kept him in a glass cage in case of emergency, break glass. And the election of Scott Brown was taken as an emergency. So for a few days, the president love-bombed Volcker, and then the infighters in the administration succeeded once again in marginalizing him. And because of Geithner's faint praise for a strong version of the so-called Volcker rule, which is really Glass-Steagall, I think Simon's right. You're not going to get a strong version of Glass-Steagall in the final conference report. And so, again, when the radical in the room is Paul Volcker, you know you have a problem.
Why doesn't Volcker do what George Bush's Secretary of the Treasury did and resign in a huff, and with making it a teaching moment?
He actually did that once. I don't think it's his style. I don't think he wants to embarrass the president, even though the president repeatedly embarrasses him. You'd have to ask him.
We might try. Let's come up here to the front, and then we'll come back to the back. We'll go back to Dana front, and then back to Dana.
Okay.
Oh, yeah. You had
Yeah. Well, the problem is that even though the Democrats had a majority, a lot of the Democrats are blue dogs or people like Blanche Lincoln who occasionally might want to do something, but really it's not in their heart. So maybe Obama is just being realistic that even if he pushes, and it doesn't seem like he's the kind of guy who pushes, although he pushed against Hillary Clinton. So, I mean, the problem is basically that, now the base of Obama is completely unenthusiastic, and on the other side, the blue dogs are not going to help him.
Right.
So where do we stand? I mean, what do you
Okay,
propose?
thank you.
Well, briefly, I broke out part of the book for an article in the American Prospect called "Give Him Hell, Barry," mentioning Truman as an example. Now, in the summer of '48, Truman faced a majority Republican Congress, plus a lot of Democrats who were Dixiecrats, anti-labor Democrats who were not New Dealers, and Truman called Congress back into special session so that he could put out a progressive program on health and on education and on employment, knowing that the Republicans would vote down all of it. But it had the virtue of demonstrating where he stood and where the Republicans stood, and of course Truman went on to win the greatest upset in the history of American politics. So I think prejudging the situation and saying, well, we dare not send up a jobs bill because we're going to lose, that's bad politics. Make the speech, send up the bill, dare the Republicans to vote against it. If a few blue dogs also vote against it, it's still primarily the Republicans defeating it, then you've got something to run on in the fall. So I think he's a temporizer, and I just hope, as he often did during the campaign, that when his back is to the wall, in spite of himself, he'll become a fighter.
You were close. Let me just really ask. You were close to Ted Kennedy, and Ted Kennedy is no longer there. Has anybody picked up his mantle as far as you're concerned? And is his absence part of the problem, Bob? And then we'll go to Simon.
Yeah, his absence is a huge hole. He was the most effective progressive tactically as well as ideologically in the Senate. I think the person who comes closest to filling Ted's enormous shoes is Maria Cantwell, who is fearless, who's a progressive, who's also a terrific tactician. But, she's not yet Ted Kennedy.
Great. Simon?
Yes, just on this specific point. On financial reform issues, I disagree quite strongly with your characterization. I mean, the administration itself says that Brown-Kalpen failed because the administration of the White House didn't support it. As I cited, there are many people on the right, as well as the left, as well as in the middle, who feel that too big to fail is too big to exist. And so that's a problem where you can mobilize your base and pull in the center. It's a huge win. Now, I agree on some other issues. There's some blue dog related matters, but if you come at it from this angle, the same angle on the fiscal deficit, who's responsible for the fiscal deficit? How did we get here? Why is it that tax reform is not central to that agenda? If you want to talk fiscal responsibility, which I'm delighted to do. In fact, I would emphasize that's my background at the IMF. It's exactly pointing that direction, but it's not the same thing as one austerity.
Right, exactly.
Dana?
Great. Thanks very much, Steve. Dana Chase and Americans for Financial Reform, and a final exam question for either Bob Kuttner or Simon Johnson. I think many people would say that the credibility of the financial reform bill that's going into conference resides with the likelihood that it's going to address in some adequate fashion the too big to fail problem. in terms of resolution authority, which is a critical piece of the effort to address too big to fail. The House provides for $150 billion in resources to the FDIC. The Senate says you got to wait till after the House is on fire before you can get the money to build a fire department. How do we bridge this gap?
Either of you? Simon?
Okay, Dana, as I think you know my position on this, which is the fundamental problem is with the nature of the resolution authority and the idea that this can rein in too big to fail banks. The resolution authority only applies to domestic U.S. financial institutions. Ironically, it would help you with something like CIT Group, but as I mentioned before, they were just allowed to fail, and that's the right decision to make. So will resolution, either in the House version or the Senate version, make an iota's difference when Citigroup is next in trouble? Citigroup operates, just as an example, Citigroup operates in over 100 countries. It's an intensely global organization. A resolution authority based on U.S. law can do nothing. There is no global resolution mechanism in the works of any form. The G20 will not take that up. The G20 deputies will be quite honest with you if you ask them about that. So I'm afraid the entire approach is saying we will have the resolution authority, this is the magic bullet, this will let us shut down Citigroup or a JP Morgan Chase. It's an illusion, and I'm afraid it's a potentially a dangerous illusion. And a little bit of money here or there, and this is small money, tens of billions of dollars in this context, it doesn't make a difference.
Let me disagree slightly with that, and the lawyers in the room maybe can overrule me, but it seems to me that when Citigroup was effectively insolvent, and they dealt with it by guaranteeing $302 billion of securities whose content they didn't even understand, plus 20 plus another 25 billion of taxpayer money, the road not taken was to say, you guys are insolvent, and we're going to do a pre-negotiated bankruptcy. We're going to figure out how much the bondholders eat. We're probably going to have to put in a lot of taxpayer money, sell off the healthy bits, and end up with a much smaller bank. I think that's possible, notwithstanding the fact that it's got 100 affiliates in other countries. I think if Congress wanted to do it, the administration were on board, you could figure out how to do it. I mean, GM operates worldwide. We figured out, I think it only took 39 days, how to do a pre-negotiated bankruptcy with GM, where all of the stakeholders took a hit, and the government ended up putting in $75 billion. So to me, this is a problem of political will. It's not a problem of legal impossibility.
Let me just take these three quick. Carolyn and this gentleman and Xia-Chen. And then we're going to take all three together and then wrap this up. Yes, Carolyn?
My name is Carolyn Poplin. I'm an attorney and a physician. But my question is economic. Since there is so much opposition or concern about deficit financing, the banks have huge amounts of capital. Is there some way to make lending for consumption less profitable and lending for production so we can pay people to produce instead of lending them money to consume, that we can mobilize the private capital to invest in production?
Thank you. This gentleman on the aisle?
Whenever I listen to discussions like this these days, I always listen through the prism of what's the impact and or the opportunities for doing something about climate change, which seems to me to be such an overriding issue that we can get all the rest of what you're talking about right and still have a catastrophe, and probably will in 20 or 30 years. So if you could address whether there are ideas, suggestions that can lead to the kinds of reforms you're suggesting while simultaneously ameliorating our coming calamity
Got it.
there.
Climate change. Okay, Chia?
Yeah, Chia-Chen, freelance correspondent, Persist American. Bob, you said president does two things, making decision and having a movement. Could the health reform term is Obama's social movement? Thank you.
Can you?
Basically, he asked, can you imagine a health reform set of decisions becoming a social movement?
Right.
Okay, gentlemen?
Well, I think the problem pre-crisis in terms of consumption and lending was that the median wage in the United States was basically flat for 30 years. And as my colleague Tamara Drought says, the credit cards became the plastic safety net. Now, it doesn't follow from that, for me at least, that we need to reduce consumption. It follows from that, for me, that we need to increase wages and increase social outlays so that people don't have to borrow to sustain living standards.
Carolyn,
Okay,
we're streaming live, so
right.
I can't have people
So
online. Thank you.
I think, yes, you need a whole strategy for rebuilding the economy, some of which involves a lot of public investment. I don't think you can do that by mandating commercial banks to lend for X rather than for Y. On climate change, sure. I mean, Sir Nicholas Stern said that global climate change is history's greatest case of market failure. And two young guys who are now middle-aged guys, Nordhaus and Schellenberger, wrote a very impolite, widely circulated paper about 3 years ago called The End of Environmentalism, who said that environmental movement can't be siloed as just about the environment. This is really about how do you regulate capitalism. So the Gulf blowout was a teachable moment. The Wall Street blowout was a teachable moment. This is all about how you harness capitalism and rebuild a managed form of capitalism for social good. And if you do that, you can get the financial system back under control, and you can also move towards a real solution to global climate change. If you don't do it, forget any of the reform goals. I think there ought to be a social movement on health care, but it ought to be a single-payer movement. And we have such a movement, but it's not all that strong because even though it polls very, very well, mainstream politicians just dismiss it out of hand. And they dismiss it out of hand because the industry has too much power.
So let me just add on the financial side, and let me perhaps wrap up on a positive note, which is the Consumer Protection Agency proposed by this administration, right. Actually very much inspired by Elizabeth Warren and pushed by her for a long time, but there's also very good people within the administration, such as Michael Barr in Treasury. This was a good idea, and this is an idea that I think will be in the legislation. This is an idea that Dana and his colleagues at AFR have also fought for. And I think that this is commendable, and I think it shows you that when you explain to people clearly, you make the case, you present the evidence, you show them how consumers have been abused, how they were trapped into a lot of loans they didn't fully understand, although there is the income pressure that Bob identified and stressed. This is part of the way forward. So, and I think saying that people are always opposed to what Bob's calling managed capitalism, the managed part, I think is wrong. I think you have to make the case. I'm actually not in favor of saying just regulate or have more regulation. Right? I think you have to look at it case by case, but in the financial side, there's definitely been abuses of the consumers, and this needs to stop. And I think on this point, the administration and the Congress have actually moved in the right direction. So thank you very much. We'll take that, and then we have to come back for more reform and do the rest of it properly.
Can I just add one point to
sure,
that? You know, you mentioned the Consumer Financial Protection Agency. Michael Barr is a great guy. That's in the white paper, and it's going to survive, not because of Michael Barr, but because it was the one issue where the President of the United States personally got involved. Barack Obama decided that this would be a good thing to do politically, and he supported it in substance, and that's why the white paper of June 2009, you know, you read most of it, it reads like a GAO report, and then all of a sudden it starts reading like Hemingway. And the part that reads like Hemingway is why we need a Consumer Financial Protection Agency. So again, this is why the president needs to be a hands-on leader if we're going to get reform, and why it's so hard, even though we can write our books and work with movements like AFR, you're really facing an uphill fight if you don't have a reform president working with you.
I try and read everything Bob Kuttner and Simon Johnson write, and the consistent theme through much of this, particularly about the banking and financial sector, was that we ended up paying off and keeping whole those institutions that took the biggest risks, that gambled the most. To some degree, those institutions that played by the rules were left by the wayside. You know, in terms of the market, what's interesting is in the financial crisis period, I heard from lots of small business owners, you know, who otherwise would have been fine, but the cut into the marrow of the sort of productive base of the country was enormous. While we were collectively holding together some of the worst players, and I am completely convinced that Simon is right, that we need a modern form of trust busting of these institutions, and if we don't, we're likely to repeat sooner than later some of these worst outcomes that we've been seeing. And we recently, I'll tell people, New America Foundation recently did a series of surveys and kind of did some PowerPoints on what we see right now in the economy. Our chairman of our board, Eric Schmidt of Google, had his team do the similar sorts of things. And there are lots of big icebergs out there that I would encourage people. These are on the New American Foundation Economic Growth Program website. Go take a look at them. So what I worry about is that the bleak prospects that you both come out with are out there in droves, not just in these areas, but there are lots of things that could come up to trigger quite another meltdown. And so I'm beginning to think that we're going to be in a shock-driven political situation, and that's why I am interested in this question of what do people like you, ourselves, and others do at that point when you've got a time of reckoning, if you will. So please join me in thanking Bob Kuttner and Simon Johnson for their outstanding work. I'm going to encourage both of them to move to our table out front right away, and you can come out and spend some time talking to them, and we'll go from there. Thank you.